Hims and Hers is a fast-growing telehealth company that is on a mission to help the world feel great through the power of better health. Recently, the company reported Q3 earnings, delivering yet another beat and raise quarter, continuing its perfect track record of beating sales estimates. Despite the strong performance, the stock is still down 70% plus from its all-time highs and down more than 40% in the past 6 months alone. So in today's video, I want to talk about Hims Q3 earnings results, what I'll be doing with my position, and why I think Hims is one of, if not, the most undervalued small cap growth stocks that you can find in the market today. As always, I will leave the link to my article in the description box below where I cover Hims in much more detail, so you might want to check that out. And with that out of the way, let's get on with the company's Q3 results. Jumping right in, Q3 revenue was $227 million, up 57% year over year. This beat analyst estimates by $6.4 million and beat management's midpoint guidance by $7.2 million. So really strong performance right away. But as you can see, growth decelerated by 2,600 basis points quarter over quarter, and this is probably the first time ever where growth dropped below 60%, but I think we're going to see this slowdown in growth continue over the next few quarters as the scale of the company begins to put pressure on growth. That said, growth was primarily driven by the expanding subscriber base, which was more than 1.4 million subscribers in Q3, up 56% year over year. On a quarter over quarter basis, Hims added 126,000 subscribers. And breaking it down by subscriber type, we can see that single month subscribers grew only 9% year over year to 293,000, while multi-month subscribers grew a staggering 75% year over year to 1.1 million. It's worth mentioning that the shift towards multi-month subscriptions will be net beneficial for Hims since longer duration plans have higher AOVs or average order values than single month subscribers. And with multi-month plans, Hims will be paid a larger amount upfront, which pretty much eliminates the risk of revenue loss through cancellations. So from a cash flow perspective, that is great for Hims, and Hims can use that money to reinvest into the business right away for future growth. So again, it's good to see that the multi-month subscribers are growing faster than the single month subscribers. And because of that, Hims saw higher AOV, which was $99 in Q3, up 19% year over year. On the other hand, monthly online revenue per average subscriber is down 4% year over year to $54 a month. And this is largely due to price cuts that Hims initiated back in Q2 to make personalized and longer duration plans more attractive for subscribers. However, this is a slight improvement from Q2 as customers chose more premium SKUs and switching to personalized plans, which completely offset the pricing headwinds in Q3, and this also gave management confidence that the pricing changes will be net accretive well within a 12-month period. In other words, expect monthly online revenue per average subscriber to gradually increase over time. All in all, growth remains strong and it's another beat on analyst estimates, and this solid, consistent execution is what makes investing in Hims and Hers so rewarding. As a shareholder, I sometimes get too distracted by the volatility of the stock price, but if we look at the financials, if we look at the fundamentals, we know that the Hims and Hers team continues to execute and build the company forward, and that gives me peace of mind knowing that the company is heading in the right direction. Turning to profitability, Q3 gross profit was $187 million, representing a gross margin of 83%, which is an all-time high for the company, as you can see right here. This was mainly driven by a greater proportion of orders fulfilled by affiliated pharmacies, which stands at 80% plus as of Q3. And as Hims transitions to 100% in-house fulfillment, which is targeted to be the end of the year, gross margins should expand slightly over the next few quarters. As a reminder, the company's goal is to provide high-quality medical care at affordable price points, and with its expanding gross margins, management wanted to pass on the savings to its customers, and that's why management decided to cut prices on some of their products in Q2. However, despite the price cuts, gross margins continue to expand, which reflects the strength of the company's business model and value proposition. Moving on, Q3 adjusted EBITDA was $12 million, which is a 5% margin. On the other hand, Q3 net profit was negative $8 million, representing a negative 3% margin. And as you can see, margins are trending in the right direction and GAAP profitability is well within reach. In fact, we could see that happening as early as Q4 this year. Regardless, one major reason why the company is not yet GAAP profitable is due to elevated marketing expenses, which grew 48% year over year to $116 million. This has been a big concern for some investors, so let's dive deeper into the numbers. I'm going to try to analyze customer acquisition costs and payback period, but let me know if there's anything wrong with my calculation. So in its 10Q filings, HIMS provided us its customer acquisition costs or CAC, and I've gone ahead and compiled the numbers for you guys, along with how many new subscribers the company managed to sign up in a given quarter. So basically how many customers they actually acquired based on customer acquisition costs they spent in that quarter. So if we take total CAC and divide it by new subscribers, we get the average amount that HIMS has to spend in order to get a new subscriber to join the platform. And as you can see, CAC per new subscriber has worsened over the last few quarters with a peak of $989 in Q2. Fortunately, Q3 saw a lower figure at $783. However, it is still substantially higher than its average of about $400 and $500 in 2021 and 2022. In addition, during the Q2 earnings call, management mentioned that marketing investments were more heavily weighted toward the end of Q2, which should provide meaningful customer acquisition tailwind in Q3. So because of this heavy marketing spend toward the end of Q2, we should have seen CAC per new subscriber drop to $500 level, but instead it remains elevated at $783, and that's because the company signed up fewer new subscribers. So notice how in Q3 last year, the company added 168,000 new members with only $67 million in CAC, where in Q3 this year, the company added only 126K new members despite spending 1.5 times more in CAC. So that is a yellow flag for me, and I will be watching this metric very closely. In addition, we have bears like Spruce Point publishing short reports arguing that HIMS is overstating its payback period and that the metric is actually getting worse and worse. But based on my calculation, payback period is actually getting better. If we look at the footnote of the company's investor presentation, we can see the definition for payback period, which is defined as the time it takes for quarterly cumulative online gross profit generated by HIMS and HERS online customers to exceed the quarterly customer acquisition costs to acquire those customers. So put simply, payback period is defined as CAC divided by gross profit. So here I've gathered all the information and calculated payback period, and as you can see, payback period has been trending down over the last few quarters, which means that HIMS is getting their money back faster, and as of Q3, payback period was 0.53 years or slightly over 6 months. And with that short of a payback period, maintaining high marketing expenses to maximize subscriber growth, in my opinion, is the right move. But to sum it up, payback period looks great. However, CAC per new subscriber must get better. Regardless, HIMS continues to expand gross margins, showing economies of scale and strong earnings potential. The company is on track to be GAAP net income profitable as well, which should be a major catalyst for the stock. At the same time, as the company grows and becomes more and more profitable, I expect HIMS to pass on the savings to customers by cutting prices, which should help the company gain even more market share. HIMS has a strong balance sheet with $212 million of cash and short-term investments with virtually zero debt, and as you can see, net cash has been building up slowly over the last few quarters, which is great to see. That's because HIMS and HERS free cash flow generation has been ramping up. As of Q3, free cash flow was $22 million, which is a free cash flow margin of 10%. And with more cash in hand, management announced a 2-year $50 million share repurchase program as well, mentioning that shares are well below what they consider to be their intrinsic value. For me, I'm a little bit mixed about the company's buyback program since HIMS is still a hypergrowth company that is barely profitable and just turned cash flow positive. I would prefer the company reinvesting all their profits back into growth, but considering the recent sell-off, the company buying back shares to offset shareholder dilution due to stock-based compensation is not a bad idea after all. Turning to guidance, management expects Q4 revenue of $248 million, up 48% year-over-year. And notice this is a deceleration from Q3's growth of 57%. They also expect adjusted EBITDA of $17 million in Q4, which is a 7% margin. For the full year, management raised their guidance once again. They now expect revenue of $873 million on the high end, which is up 66% year-over-year. The previous guidance was $850 million, up by 61%. So that was a raise of about $23 million, reflecting strong demand for HIMS and HERS products. In addition, they now expect adjusted EBITDA of $46 million, which is a 5% margin, up from the previous guidance of $40 million, reflecting continued operating leverage within the business. So overall, another beat and raise quarter and really strong guidance by management. But whatever it is, HIMS and HERS growth story remains intact. There are so many categories left untapped, such as testosterone, menopause, and eczema. The company also recently launched MedMatch, which is a service that leverages AI and machine learning to identify the most optimal treatment for patients based on the company's expansive data set. MedMatch is currently in beta for customers seeking mental health support. If successful, HIMS can deploy this service among other categories and even potentially license the software to health institutions, which opens a new revenue stream for the company. In the next few weeks, investors can also expect the launch of HIMS and HERS weight management offering, opening the doors for the company to enter a category that is worth hundreds of billions of dollars. So given the company's recent product launches, I have no doubt that HIMS and HERS will become the one-stop shop for high-quality, personalized, multi-category medical treatment. In my previous video, I declared HIMS and HERS stock stupid due to the fact that the stock sold off immediately after Q2 earnings, despite posting a triple beat on analyst estimates. My guess is that the stock sold off likely due to the price cuts that management announced, which might have scared some investors because price cuts may mean lower margins or lack of demand. But Q3 results say otherwise, with gross margins at an all-time high and revenue growth beating analyst estimates, and that is probably why the stock rallied following Q3 results. But if we take a look at the chart, we can see that there's two major resistance that HIMS stock is facing right now. First, we can see that the uptrend line has been broken to the downside about 2 months ago, so that trend line has turned into a major resistance. Second, we can also see that HIMS broke major horizontal support right here a few months back, so that major support has now turned into major resistance as well. And as you can see, the stock failed to rally above the two major resistance levels despite strong earnings results, and because of this rejection, I won't be surprised if the stock pulls back a little before reclaiming its highs. But technical analysis aside, let's take a closer look at the company's valuation. Based on an EV to revenue multiple, HIMS only trades at 1.6 times its revenue, which is a massive discount to its peak of 31 times and even its average of 5.2 times. Its lowest point was 1.3 times, so the stock is still trading at the bottom of its range. With HIMS being a much larger and more profitable company today, I think the stock deserves a higher multiple than just 1.6 times, which in my opinion is just beyond cheap. And maybe that's why smart money is loading up on the stock as well, as the stock sold off in the last few months, which should be a confidence booster for investors as well. I did a DCF valuation analysis on HIMS as well, but I won't go into detail here. If you're interested, you can check out my article or watch my previous video on HIMS and HERS right here. That being said, based on my DCF model, my fair value estimate on HIM stock is $22.84, which is more than a 200% upside potential based on the current price of $7. This fair value estimate is also double the average analyst price target of about $10.85. So if you haven't noticed yet, I think HIMS is incredibly cheap. You might think that my assumptions and projections are too aggressive, but if you read my article or watch my previous video, you'll see that my valuation model is actually very conservative. So yes, I think HIMS stock is incredibly cheap, probably the most undervalued small cap growth stock out there. And when you consider the $50 million share repurchase program, the company turning profitable, as well as the company trading at the lowest multiple ever, I think the stars are aligning for HIMS stock to soar higher. To close this video, HIMS have shown nothing but relentless execution on delivering its mission to help the world feel great through the power of better health. We see this with its financial results, we see this with its innovative product launches, and we see this with its consistent outperformance. To me, HIMS is probably the most undervalued small cap growth stock, trading at just 1.6 times its revenue. And this kind of valuation is unheard of for a company that is growing 50% plus, have gross margins of 80% plus, virtually no debt, turning profitable, and have software-like revenue. And yet the stock is struggling, probably due to competition and elevated marketing expenses. I think HIMS stock is just highly misunderstood, but this means that there's more time and opportunity for investors to build their position on this telehealth giant in the making. And for me, I will be adding to my position if we see further weakness. Well, that's it for today's video. What do you think about HIMS and her stock? Please let me know in the comment section down below. If you do find value in this video, please leave a like, comment, and subscribe to my channel for more investment content like this. As always, I appreciate you guys and I hope you have an amazing day. Thank you guys, and I'll see you guys on the next one.